Okay, this is Business 342 workbook pages 82 through 87. The cost of capital. Cost of capital of a firm is defined as the expected return on a portfolio of all of its existing securities, which means their debt and equity. Required return is from an investor's point of view, whereas cost of capital is the same return, so it's the same percentage return, but it's from the firm's point of view. Okay, the return that an investor in a security receives is the cost of that security to the firm that's issued it. Once the borrower, or not the borrower, that's equity, but you can understand their point. One person's gain is the other person's cost, right? In this case, company's cost. In fact, cost of capital, required return, and appropriate discount rate are different phrases that all refer to the opportunity cost of using capital in one way as opposed to an alternative financial market investments of the same systematic risk. Remember, your return is based on the systematic risk, which is undiversifiable. They don't give it to you for unsystematic risk, which is diversifiable. There are three capital components of a firm. So there's three ways that firms raise capital: common stock, which is equity. They raise it through debt, which is bonds usually, some type of borrowing, or it can be just bank loans. And preferred stock, which is kind of a combination of stock and debt. Mostly it's considered debt though. And an increase in total assets, so increase in the total assets of a company has to be financed by either an increase in stock, debt, or preferred stock. Okay, so it says the cost of the components is called the component cost of capital. So RE is the component of equity, the return on equity, return for equity. RD, and that's the return for debt, and that's the interest on new debt, which is the yield to maturity, is what you figure. It's not just the coupon rate. Remember, if bonds are priced out, they're priced at yield to maturity, which is the coupon rate plus any discount or any premium taken into account. And that's before tax. The percentage is figured before tax. And then the after tax is figured out just whatever your cost of your debt is, the percentage, the return for debt that you're paying, times 1 minus the tax rate. So if you've got a 40% tax rate, what they're using a lot, your actual cost is only 60% of that, 1 minus 40%, right? Because you get to write off the other 40%. It comes right off of your taxes. The after-tax component of debt, where T is the marginal tax rate. And marginal tax rate is used because it's the tax rate of your last dollar, so that's what it's going to be costing you at that point. Okay, and P is the component for preferred stock. So that's basically when you're figuring out the return on preferred stock. Cost of equity. Note that there are two sources of equity capital: internal equity generated through retained earnings. So when you have retained earnings, you've got an equity that way. Your equity has increased. And because if you remember accounting, retained earnings goes into your equity side. And external equity obtained by issuing new common stock. So those are the two sources of equity capital. Okay, the component cost of retained earnings, internal equity, is less than the cost of issuing new equity, which is external equity, and that's because of the flotation costs. You got all those costs with attorneys, accountants, everything involved with floating a new stock issue. Okay, but bonds have the similar type of cost too. But retained earnings don't have that cost, and that's their point. In this chapter, we will ignore the flotation cost and therefore just study one cost of equity. In most instances, that is not an issue because equity generally comes from retained earnings, which means that corporations don't go around and sell stock all the time. So most of the time, their increase in their equity is coming from retained earnings. The cost of equity is the rate of return equity investors require given the risk of the cash flows from the firm. There are two major methods for determining the cost of equity: the dividend growth model and the SLM, security market line, or the capital asset pricing model, I think that's called. Okay, so that is page 82 for the Business 342 lecture.